Thank you so much for those of you who have spent time with us before, and an even bigger thank you to those who are joining for the first time. We're really glad you're here, and we are tickled that you are willing to spend an hour with us to learn more about the market. It's your market, it's not our market, it's what you guys are doing out there, helping buyers and sellers, and it's your data, right? The brokers own the data. MAR does not, Northstar does not. But what we do is we take all that data, every status change you all have ever had, we take it and we feed it into a database, right? And we're able to say how many active listings are there, how many new listings were there, how many signed contracts were there, how many closed sales were there, what was the median sales price of those closed sales, what was the price per square foot of those closed sales. I'll spare you all the rest, but just know that, when we get your hard-earned status changes, we do some massaging and then we turn it into what we like to call maybe actionable intelligence or actual, useful information. I like to open on a light note. After all, when you do data for a living, it helps to lighten things up just a tad. So belief is what you do when there is no data. And without data, you're just another person with an opinion. One of my personal favorites, data is the new bacon. Everybody loves it. Everybody wants more of it, and it is delicious. Kind of thinking a little bit deeper. So here we are, we're drowning in so much information, but we're still starving for wisdom. And that's kind of, a big part of what today is going to be about over the next 55 minutes or hour or so. We're gonna exchange some of this information overload, and we're gonna swap it for wisdom, right? We're gonna trade in this raw information, and we're gonna kind of get back wisdom and intelligence and a better understanding of the market, and just so we can all be better market experts and give better customer service to our buyers and sellers. With that, let's just talk agenda very briefly. We're going to start, as we usually do, talking about the market, short and long-term trends. So we'll do some weekly numbers, we'll do some rolling daily numbers actually, and then we'll do some monthly trends. And we even have some, not year to date, because obviously year to date for January is just January, right? This is the one time a year where year to date is the same as the month. So we'll have some annual stuff as well. So even daily, weekly, monthly, and annually. So lots of different intervals today. So that should be exciting. We're going to dive into market segmentation. As we know, not all components or segments of the market behave the same. So sometimes single family can do different things than condos. Sometimes new construction can behave quite differently than existing or resale properties. Sometimes the third ring suburbs do better than the core cities. Sometimes the core cities do perform better than the outlying areas. So it's really important to kind of break down the market into its segments or submarkets. We're going to also talk market reports, and time permitting, we're going to jump into maybe a quick 10-minute InfoSparks training. I'll spend a couple minutes doing kind of an economic and recovery update. We won't spend a ton of time there. And then we, of course, welcome your questions. By the way, I know Sarah mentioned this, but please do put those questions into chat or into the Q&A section. And if I can, I'll try to spot them and just kind of answer them on the fly. Answer them on the fly so we don't feel like we have to hold them all for the end. Okay, with that, let's keep trucking. So let's kick things off with the market. We're going to start pretty high level, as we often do. Three kind of what you might call macro level trends or overarching trends. So one, I would bet everybody on this call is well aware of number one, right? Buyer activity is remarkably strong, right? Oops, my doorbell's ringing. Buyer activity is remarkably strong, right? 2020 was a record-breaking year for sales. Both pendings and closings reached their highest level since at least 2003, likely earlier. That's on the demand side.
We have a question here too, David. It looks like Greg asked, does the market data suggest an influx of out-of-state buyers to the Twin Cities?
Oh boy, we're just getting started, and that is a good question. we don't really capture, the MLS data doesn't really capture out of state versus in state. There may be some other sources to look at. So I think for that one, Greg, I may follow up with you offline. I know there's a couple other resources. I know, what is it? The van, I can't remember. The van lines, there's some moving van lines that collect data on, where people are going. And then some of the U-Haul or budget truck rentals that show who's renting a truck and where are they dropping it off and this kind of thing. So there is some of that. But remember, because of fair housing legislation and regulation, we really don't collect a lot about, the demographic aspects of a buyer. I know NAR does some of that with their profile of buyers and sellers, but that's because they do survey research that's sort of outside of MLS transactions. So they'll send out a survey to, say, 1,000 people, and get how many responses. And then they'll say, hey, the average age of the first-time home buyer is 31, so on and so forth. So I think I'd want to take that one offline, but really good question. Okay, so we were talking demand. Demand is really strong, but then there's new supply coming on the market, seller activity, also known as new listings, and that activity is still relatively weak. So sellers barely budged in 2020. Looks like they were up 0.1%, 0.1% over 2019. However, December did see a 23% spike in new listings, which seems like a positive thing. I think the market is thirsty for more supply, more listings. Buyers want this. The market needs this. So felt like a good thing. And then January, new listings were down again by almost 9%. So we are seeing some mixed signals here. All that, the fact that demand is historically strong and supply is still pretty weak, right? We know how this is going to end, right? We've watched this movie before, and it ends with less inventory, right? So inventory, or the number of active listings, or the number of homes for sale, these are all synonymous. It's by far the biggest factor that's holding back sales activity and frustrating buyers. So, if you actually look at a count of the active listings, we've come down 75% from 2010. And that's at a time when sales and population levels have only grown. Okay, so let's pivot into some other thoughts here. So, eventually the market might push back against rising prices.
And David, sorry to interrupt, but we do have a hand up.
Oh, we got a hand. Okay.
Go ahead, Audrey. You can unmute yourself.
Hi, so you were referring to the, let me see, new listings are down by 75%. Is that the metro? Is that just the Twin Cities? Is that the state?
No, that is just Twin Cities metro. So that is the official census definition of the metro. Yeah, good question. It's not statewide, but it's also not just, Minneapolis or Minneapolis and St. Paul. That's kind of the broader definition of the Twin Cities metro.
Thank you.
Yeah, no problem. Okay, let's see. So, right, we were talking, this could kick off the next market cycle when you start to feel some of that pushback. And then, rising prices could or should incentivize more supply, both new and existing. Now, for now, homeowners are enjoying the ride up, and many of them are remodeling and choosing to stay put for longer. Some evidence this is changing, but again, the data is giving some mixed signals in that regard. So the inventory shortage kind of becomes a self-fulfilling prophecy, right? I won't list my home because there's nowhere to go. And there's nowhere to go because I and my neighbors won't list our homes. So kind of a funny cycle there. All right, let's keep trucking. Okay, so now we're getting into some of the meat of today. This one is one of my favorites. Couple reasons. First of all, I like that we've broken out the last 3 years. So we've got 2019 here in light gray. We've got 2020 here in dark gray. You can really see the impact of COVID, right? Pretty noticeable footprint here, where mid-March, you really saw showing activity plummet, and then it got right back on track only about a couple months later. And then we also have 2021 here in blue, where we can see, hey, showing activity is off to a really strong start for this year still, right? There was some evidence last year that maybe things were kind of not slowing down, but that showing activity was no longer hovering so much, not as much above as it was compared to the year prior. It looks like no, showing activity continues to trend well ahead of both 2020 and 2019 trends. I really like how, I shouldn't say I like, it is so clear and so telling, exactly what happened to showings last year compared to where they would have been, say, in a more typical year like 2019. I say typical year like 2019. Is there ever any typical year? There is no normal. There's just different forms of weird. I think that applies more to people than to markets. But if you look at 2019, notice it was actually lower because we had such a fast melt, right? We had some late snow and some wet snow and a fast melt, and so that kept some folks off the market. And so we can kind of see the impact. Guess what? If you don't have as much product to show, your showings, your showing activity is going to be a little bit suppressed, a little bit lower. Again, one of the biggest takeaways, and perhaps the most encouraging takeaway, is that showing activity this year in 2021 is still trending well above levels from the last 2 years. And that means, of course, showings as a leading indicator, right? That tells us that strong showing activity will translate into, right, strong mortgage approval, right, which will translate into strong signed contracts, which will translate into strong sales numbers, which of course support prices and kind of help the market go round. Okay, so that's daily showing activity. How about breaking things out by list price, by price point? So this is overall showing activity by price range. You guys will notice it's for the most recent week this year compared to that same week last year. So let's take a look. We can see what's happening with showing activity in the under 200K range. No surprise, folks, it's down. I bet any of you could have predicted that. There just isn't nearly the amount of product. There just aren't enough homes in this price range to allow showings to continue to grow. Where is a lot of this demand going? Where's a lot of this showing activity going? Well, it's falling off from here. Looks like it's being reallocated to the next price rung up, and even more so actually to this 250 to 300K range. So about $250,000 up to 300,000. That looks to be one of our biggest gainers, maybe tied with this 300 to 400,000 range, where we also saw a really fairly noticeable bump in showing activity. And that's really the case all the way up the price ladder, with the one exception of that most affordable segment under 200,000. Every other segment saw an increase in showing activity, an increase in buyer interest, if you will. Okay, market share. Let's pivot a little bit. This sort of custard, maybe pumpkin or sweet potato color is the pie that I have not yet eaten, and this sort of white or foil color is the pie that I have eaten. So we're going to talk market share, right? Doesn't matter if I have, 25,000 is 25% of 100,000, 250,000 is still 25% of a million. So it doesn't really matter if the pie is growing or shrinking. What matters is, what does my slice of the pie look like, right? So what is my slice of the pie? So even though, so again, really a fascinating difference here. Well, sometimes it's different. This actually looks to be the same, but I guess what I'm trying to say is, even if we see a gain here, even if we see an increase in the number of showings, sometimes we can still see a decrease in the share, right? And actually, I stand corrected, you guys. Look, we saw an increase in the number of showings, but we saw a decrease in the market share, or the share of showings. Why? All that means is, even if we had more showings, it looks like other segments grew even more, meaning they were taking a bigger slice of the pie, which meant your slice of the pie shrunk a little bit, even though we saw a gain. So sometimes I know people struggle with that. Apparently, I just struggled with that. So don't feel bad. That's a little bit of a wonky thing. But it's possible you have sellers asking you, what's going on with showings? Why hasn't my home sold? I'm hearing all homes are selling in 4 hours, for double the asking price. Well, That's not really how it's going. Even though the market's pretty strong, there's a lot of caveats there. So all the way up to a million plus, right? 1.2% of showings last year were on million plus listings. 1.34% of showings this year were on 1 million plus listings. Pretty big change here, guys. 300 up to 400K, 13.5% last year on products in this range versus 16.5% this year on those listings between 300,000 and 400,000. Another way to look at that is just to say, what is that change in showing activity by price point? Sure enough, there's your segment, your most affordable segment. That's where you have your loss, your roughly 20% decrease. All other segments showed a nice bump, a nice gain in showing activity. The most dramatic by far was 60% more showing activity in listings between 800,000 and a million. So 8.25, 850, 950. By the way, guys, I know there's a lot of, well, I shouldn't say all the time or a lot of the time, but oftentimes, maybe sometimes, a listing, a seller's asking 1.1 or 1050, and a lot of those will end up at, 999 or 950. So sometimes you see some of those listings with price adjustments, what would have started up here kind of ends up in this range. Okay. Now we're looking at new listings. Again, metro-wide, this uses our rolling weekly average. So basically, we're comparing seller activity here in 2021 to seller activity for the prior 3 years, right? For 18, 19, 20, and then here we have 2021 in black. Where to begin? There's a lot of interesting insights and takeaways here. I guess let's start with, I think, what is a big question, right? What was the COVID impact? We can see 2020, right? Pretty clear to see when sellers weren't listing as many homes. And then they kind of got back on track and they kind of flatlined a little bit. It was nice to see that seller activity in 2020 was ahead of those prior years. But, here we are in 2021 and we're actually running below, maybe not well below, but we are running, noticeably below the new listing levels from the prior 3 years. That's not an excellent sign if you're a buyer looking for, more choices. You're hoping to have more options, especially in the affordable ranges, say under 300 or under even 3.25 or 350 nowadays. However, if you're a seller and you're liking the appreciation and you don't have an urgent need to sell, maybe you like prices rising this quickly because there isn't as much seller activity. So there's 3 sides to every story. My side, their side, and then there's the truth. So pending sales, take a look at the demand trend here in black for 2021. You can also see the demand trend you can see the demand trend for 2018, 19, and 20. But look at 2020. Here again, folks, you can see that March, April impact on pending sales. So this is on the demand side. But notice how quickly we got back on track. And even after we got back on track, notice how 2020 pending sales, right, were trending or hovering well above the levels from the prior several years. So that's why we reached so many record highs last year, right? Because of this, because demand stayed well above that levels from the prior years. Even though we had some room to make up here, right? We had a loss here. All these gains here more than made up for some of the losses here. So pretty fascinating one. I really like how, I really like the story that this tells. Don't forget, where are we? Memorial Day, 4th of July, Labor Day, Thanksgiving, and then year-end holidays as well. So you can really see the impact on the market, which is, of course, interesting as well. I know we've already been talking market. We're going to talk more market. We're getting into some slightly longer term trends. So we're going to start with a few weeklies, then we'll get into monthlies. So change in new listings. So let's forget about showings. Showings are fascinating. And we looked at sort of daily trends for new listings and pending sales. But now let's take a look at the change in new listing activity by price point. So changes in seller activity broken out by various price brackets. down 17% overall for the most recent week this year compared to that same week last year. So there were 17% fewer new listings. However, there were 43% more new listings on million plus properties and 40% fewer new listings on properties priced between roughly 150 and 200K. I think this is an important segment. Our median sales price is right around 300 or 305. So this is a really important segment. It is encouraging that we only saw a 4% decline in new listings versus a 12, 40 or 30% decline. But we really need this to be above zero, right? You guys know that. We really need this to be above zero in order to get more product into the hands of all these buyers who are motivated by interest rates, looking to get a little bit more space, looking to get a home office, a second home office, a first home classroom, a second home classroom, so on and so forth. Okay, so that was new listings by price range. How about pending sales by price range? Same period here, most recent week this year compared to that same week last year. So apparently, we're back on new listings. Apparently, all these million plus sellers, they're not crazy, right? It kind of looks crazy, right? Everything else is down. Why the heck are you guys in million plus? What is this rally about? No one's listing. Why are million plus sellers listing, right? Usually when we see even, maybe more listing activity here, sometimes luxury can be down. And now it's just the opposite. Well, guess what? Look at all that demand. We saw a 135% increase in the number of signed contracts on million plus properties for the current week of this year compared to the same week last year. Now, 130, 140% looks like a big number because it is, right? Because it is. However, just remember that if we go from, say, 5 pending sales this week to 10, right, that's a 100% increase. It's only from 5 more signed purchase agreements, but it's a 100% increase. So to go from 10 to 15, that's a 50% increase. 10 to 20, obviously again 100% increase. So say 10 to 23, right? So maybe it's only 5 or 7 or 13 or 20. It's not a big number. It's a huge change, but it's not necessarily the biggest number. And here again, we see sales activity softening in the most affordable brackets where, again, there just isn't the product there to write offers on. So no wonder we're seeing fewer offers. This is why I said, you guys, this is why I said this segment is important. We need to see growth here. Take a look why. Look at pending sales in that $250,000 up to $350,000 range, right? Up about 7%. Seller activity down 4%. We need some more product here if we're going to sustain these gains in demand. We need more product. I know we looked at million plus, but I should have just commented briefly. $500,000 up to $750,000 and even $750,000 up to $1 million. Pretty robust gains in our luxury segments, right? What's happening here, guys? Well, interest rates are low for everyone else, so that means they're also low for jumbo rates on higher priced sales. It also means, I think those with the wherewithal to do so are able to change their living situation. They're able to get more space. They're able to move out or move in or move up or move down or what have you. And so, I think this speaks a little bit to what's happening in the economy, right? Business professionals are faring relatively well. It's everybody else who maybe works, service sector or retail or leisure, hospitality, restaurant, dining, nightlife. How about cruise lines? How about Delta Airlines? Some of these folks are still very much hurting. So we don't see gains there. Also, there's very little inventory down there. But I think it's pretty interesting how, some of the trends out there, maybe some socioeconomic trends can sort of trickle into our data here. Also, a lot of these folks, you guys, it's okay. We don't have to be afraid to say it. They're high net worth individuals. Nothing wrong with that. That's a good thing. They're high net worth individuals. A lot of high net worth individuals have their assets in stocks. Well, stock market is kind of back to or near all-time highs. So they're feeling, they're feeling pretty good. They're feeling pretty good about their financial position. So that was weekly data. How about monthly? The weekly numbers are good because obviously there's about 4 sets of weekly numbers per month. I'll pause for a minute if you need to do that math. Most people get 12 months older each year. Me, I age about 18 months every year. So, this is why I like to look at the monthly numbers, because it's a little more stable, a little more steady. The weekly numbers can be, just the opposite, a little more volatile, a little bit more noise in the data is one way to think about it, just more noise, more movement. So change in new listings by price range for January of this year compared to January of last year. Biggest loser, right? About 120 to 150, right? So really anything under 250 saw less new listing activity, saw fewer new listings come on, right? Weaker seller activity. Some of these guys actually saw a little bit of a gain in new listings, right? Not a huge one, but a little one. So like we just saw, you guys, right? This is a perfect example, right? So it's 0.7 for the month, but we had a week that was almost 7%, right? So we need, oops, I'm sorry, guys, new listings. That was my mistake. New listings down 4% for 250 to 350 for the week, but new listings up almost 1% in this 250 to 350 for the month. So forgive me, I hope I didn't cause any confusion. Just know that, as the week goes, the month doesn't necessarily go, and as the month goes, the week doesn't necessarily follow either. New listings. So we actually, for the month, we actually saw a softening in million plus, but we did see our largest gainer was in the 750 up to $1 million range. Pending sales, quite a different story, my friends, quite a different story. So pending sales demand up, as you get over 250,000, sales were rising, in all price points over that 250K price point. So all the way up to $1 million. In fact, million plus homes, 60% more contracts signed. Remember, though, that can be from 10 to 16, right? Going from 10 to 16 is a 60% increase, even though it's only 6 more sales. So 6 sales doesn't sound like a huge number in a market that has 60,000 a year, but a 60% gain does grab your attention, kind of grabs you by the wrist and wants to pull you in. Okay. So we're going to switch gears again, and this is where we look at our monthly trend. So this is January, but it's every January going back to 2003, right? And why do we do this? Well, it wouldn't really make sense to show you guys every month of every year, because it would just look like a sine curve, right? Kind of up and down and up and down and up and down, because we have seasonality in our market. What this does is it allows us to look. It allows us to do apples to apples comparisons by simply looking year over year. So January new listings in the metro going all the way back to 03. So this is Jan of 03, 3% up to Jan of 04, 4% down into Jan of 05, so on and so forth. You guys can kind of see some evidence of a bubble here, kind of a supply-driven bubble. Interestingly, now we don't have any sort of supply-driven market. We have a demand-driven market, which is why I always find it a little interesting when people ask, are we in another bubble? So take a look at what's happened. Ever since then, we've come down after the Great Recession and the mortgage and foreclosure crisis. We've fallen down to about 4,000, just about 4,000 new listings per month, down from 9,000 in good old 06 and 07. So January was down 8.7, about 8.8% from last January. And you guys can see, technically, it's the lowest number of new listings we've seen in a January on record, right? Going all the way back to 03. So what is that, an 18-year record? Take a look at pending sales. Again, every January going back to 03. Different story, you guys, almost a polar opposite story, right? New listings have been kind of weakening and weakening and weakening since 07, 08. Pending sales have been strengthening and strengthening and strengthening ever since 08, right? This X, right? The fact that supply is going down and demand is going up, this is what is causing inventory levels to dwindle and what's really suppressing inventory levels. Because, virtually everything that's listed, okay, yes, with some caveats, gets snapped up so quickly in this very low supply, high demand environment. So pending sales up about 6% for January compared to Jan of 2020. You guys can kind of see maybe a little bit of softening into 2018. I know rates kind of jumped around then. So, a couple different kind of patterns or trends here. 3,500 is the second highest on record, the second highest January on record, with the exception of 2005. So, there's a whole lot of sort of takeaways here. And you guys can really see that. How about closed sales, closings? So we already talked about how, pending sales are a leading indicator. It's kind of the thing before the thing, right? Before you close, you go under contract. Before you go under contract, right, it has to be active. Before it's active, it has to be newly listed. Before you go to a showing, you're probably going to have a pre-approval letter. So we like to get earlier and earlier in the process, but it's worth noting, that doesn't mean closed sales aren't important. It's worth noting that closed sales might reflect some of the strength from November and December, right? Because those contracts signed in November and December are now closed sales for January. So that's why it's interesting. Pending sales, right? This is kind of a forward look. It is great to have a 6% gain, right? That's fantastic. That's a good, solid number. What's interesting is just to consider that this 15% increase in closings, well, now if you look at, again, this reflects November and December. This 6% increase in January pendings will likely be a 5, 6, or 7, or 8% increase in February or March closings. So this strong closing number reflects pendings from a month or two ago, but this new pending number, right, will soon be reflected in this closing figure. I hope that wasn't confusing. I even confused myself a little bit on that. Just know pending sales, leading indicator, closed sales, lagging indicator, the changes that we see now with pending sales, we're likely to see trickle through closed sales in a month or two. All righty, CDOM, cumulative days on the market. If you were on for 30 days and then you're off for 10 days, coat of paint, floor sanding, carpet steaming, get the smell of cats out of the house. Not sure. And then you're back on for 30 days. Well, you might try to fool us, but you're not going to fool us. We know you were on the market for 60 days, right? Even though it was 30 on, 10 off, and then another 30 on. So it's really 60 days cumulative days on market. So let's take a look at this. 130 days down to 20, right? We've scrubbed 110 days off of our market times. It's really, really quite remarkable. Homes are selling in half the time, right? 21 days versus 43, about half the time compared to last January, right? Jan of last year. So, this shouldn't be a surprise. We see fewer new listings. We see more and more sales activity. Of course, that's going to mean, right, we're in this competitive bidding, this multiple offer environment. Folks know that if they don't take a swing at these listings right out of the gate, they're going to miss out. And I think people are feeling that FOMO, right? So it's tough. And we know that, even though this looks like 21 and a half days, some homes are taking 2 hours to go under contract. Other homes can take a year, right? So just know that this is a median. Half the homes take over 21 and a half days to sell. The other half of the homes selling in less than, fewer than 21 and a half days, or about 3 weeks. All right. Let's see. Time check, we're 2:35. Okay, I think we got to keep going. So January median sales price, what do we notice, you guys? 11.5% up to 301. It's a pretty sizable gain, 11.5. Let's see, so 10, 11. So it looks like that was our strongest year-over-year price gain since 2013, right? And that's telling us that, again, something is different here, right? There's something happening here, as the song goes. So, of course, this is reflecting that what we just talked about, this multiple offer situation, some of the competitive bidding, a really low supply and extraordinarily high demand environment. Of course, that pushes prices higher. That exerts upward price pressure on the market. And we're seeing that reflected right here. Year-over-year change in median price. So another way to look at this is, again, I've taken this all the way back to 04, and we can look at the change in pricing. So this is by month, right? So remember, this was for January. Well, this is for January of each year, right? But that's just for Jan. This is kind of nifty because it looks at each month within, obviously within each year. So this is Jan through December of 04. Same, obviously, you guys know the months of the year, I hope. So this is every month going back to 04. And it allows us to spot some things that we wouldn't ordinarily be able to. We can spot trends faster. We can spot changes a little more quickly. We can really see the impact of that tax credit that stabilized the market in 09 and 2010, but didn't really lead to widespread market turnaround, right? Even though it kind of stabilized things here, we had to kind of balance out and find our footing before we got back into the blue or back above zero. So yeah, you can see, guys, price growth is higher than it has been, right? So maybe we haven't hit quite, that high of maybe we haven't hit this high water mark, but, we are sustaining pretty high levels of price growth. Obviously when we were coming out of recession, you saw a ton of demand. Rates were fantastic. Every home price just went on sale. And you saw a lot of flippers coming in and do rehabs and flips. And so you saw a lot of growth there as well. But we are seeing, clearly there's something different here. All right, let's just spend a minute talking median versus average. I do this maybe every other session. A couple of you have said how useful it was. So I think I may do this every time. Jeff Bezos walks into a bar, right? There's 6 people at the bar earning anywhere from 40 grand a year up to 125 grand a year. In walks Jeff with 200 million a year. What's the average income for folks in this bar? It's over $28 million a year, right? What's the median income in this bar? $65,000 a year. Why? Half the people earned more than 65K. Half the people earned less than 65K. That's why it's a median. Average is skewed way higher by Jeff as an outlier, right? He's an anomaly. He's an outlier. The median is insulated from that outlying activity, from those anomalies, right? The average is not. It is very much susceptible to that, right? So this was 200 million. Look at what that did to the average. Now here walks in Jeff Bezos, and this is probably a little more accurate. 200 billion. What's the average income now? Well, now it's $28.5 billion. Well, that must have moved our median, right? No, not a penny. The median is still here at 65,000 because we have 3 above and 3 below. That's kind of the glory of median, right? That's why it's glorious. You got a lot of homes selling on either side of 300 grand, and then you got 1 or 2 homes selling for 1 or 2 or 3 million. Do you really want to let those multi-million-dollar sales really skew up that average or, typical price? Both have a place, but I just want you guys to know the difference. So really, really briefly here, let's apply this to 5 houses, right? 150, 2 1/4, 275, 350, half a mil, and 3.5 million. What's the average sales price? 830 grand, right? What's the median? 312.5. Why? Because here we have an even number, we have 6, we have to split the difference between sale 3 and 4, right? We split the difference, and that difference is 312.5. That's the midpoint between these two figures. PPSF, price per square foot, $165 per foot, roughly, right? Compared to 137 at the kind of peak of the bubble in 06. So interesting. Just a word about this, you guys. You have 2 homes, right? Home A, Home B. Clever names, I know. Home A is 200,000, home B is 400,000, right? You might notice those prices aren't the same, right? But square footage doubles. So from 2,000 to 4,000 square feet. So let me get this straight. Even though my price doubled, if my square footage doubles as well, then my price per square foot doesn't change a penny. That's correct. That's exactly how that works. So, some people love this, some people hate this. I think it's just another tool in your toolbox, or another way to think about it is it's just another lens to look through. It's another lens to look through to gauge market health, just another tool, just another lens. And let's keep in mind the same 2,000 square foot home in, Roseville, that same 2,000 square foot home, layout and everything, what might cost 200,000 for that 2,000 square foot home in Roseville might cost 350,000 for that same 2,000 square foot home in Edina or Wayzata. So just know that just because price doubles, doesn't necessarily mean square footage doubles. In fact, you could have a $200,000 house and a $400,000 house, both of which are 2,000 square feet, right? But the finishes are nicer, or the layout's nicer, or I don't know, it's a walkout, or one's on water, or one's a 2-story above versus a rambler with finished below that isn't a walkout, right? Lots of different factors, guys. So another way, we were just talking about, and Greg, I do see your question, so let me get to that in just a second. So we were just talking about, different lenses to look through. Different tools, different lenses. Well, let's look at a different metric, percentage of original list price received. Wow, take a look at this one. Sellers are getting 99.5% of their original list price received at the time of sale, right? That's what they're getting, 99.5%, up from 97% last January, right? This is, whether it looks like it or not, this is a pretty seismic shift, right? The same way this was a seismic shift as we were recovering, right? So take a look at this, 2.5%. That was seismic as we got out of the doldrums from the Great Recession, right? And now clearly there's something else seismic happening. So plus 0.1, even plus 1 or plus 1 or plus 0.2, right? All right, 1.5 is a pretty strong number, but it's not 2.6. So clearly something is happening here. Inventory. We can skip over this one because there's plenty of it, right? That was a joke. No, we're not going to skip over inventory because this is the number one factor that's holding back sales, that's kind of driving some buyers crazy, and that is causing some frustration and consternation out there in the community. So January active listings. We used to have 30,000 in January of 2008. I'll say that again, 30,000 properties listed under active status in Matrix. How about now? 5,000, right? We have 1/6. We have 1/6 the amount of inventory that we did 13, 14 years ago, right? That's a pretty remarkable statement. And it's meant that we have less than 1 month of supply, right? This is months of supply. At one point, we had 9 months of supply in Jan of 2008. And then you can see we dropped to 5, and then we dropped well below 5, and now we're below 1 month of supply. Most of you guys are aware we're shooting for, well, the literature changes a little bit. Everybody has opinions on this. We used to say 5 to 6 months of supply is a balanced market. Some are now saying 4 to 5 months is balanced. Some leave it at maybe 4 to 6. Maybe we can expand that out to 4 to 7 months. Anywhere in that range of roughly, 4.5 to 6.5 or 4 to 7 months of supply is a relatively balanced market, right? Over 6 or 7 months, or especially over 8 months, right? These are buyers markets. This is when buyers were in control. They could go into a listing and make lowball offers, and sometimes they'd win the keys. Here, that strategy is completely ineffective, right? It's a completely ineffective strategy because in a market with less than 1 month of supply, that tells us that there are very likely to be multiple offers, and it's very likely that one or more of those offers are going to be full price offers, if not above full price offers. So just again, it just speaks to how strong of a seller's market we're in. where sellers have the power, sellers are in control, versus being in a in a solid buyer's market where buyers are holding the reins, buyers are at the wheel, and they have more control. So what does this mean? I won't go into the details. Just know that there's some explainers down here. Sellers markets under 5 months of supply. You've got all these buyers already and pumped up and got their pre-approval letters in hand and are armed with their HGTV designs. Thanks, Chip and Joanna. Look, they're all competing over the same house or two, right? So that's a seller's market. Whoever's selling this house has control. They get to pick the best offer for them. They get to handpick their best offer. Buyer's markets over 6 months of supply, right? This is where, you don't have that many buyers, but you do have more sellers. So all three of these sellers have to kind of compete with one another in order to lure in one of these buyers, meaning in buyer's markets, it's pretty likely some of these sellers are going to have to make concessions, either price reductions, they'll have to do some seller pays. And, by the way, there's still some seller pays, as we know, in sellers markets. They're not as likely and not as much and not as common, I should say, as they would be in buyer's markets. What we're shooting for is a balanced market, right? It's not complicated. We've got a pretty good number of homes. We've got a pretty good amount of supply that's well synced up with, our demand level. Diving a little bit deeper into some of our affordability trends. Diving deeper into our affordability trends. Okay, before we do this, guys, let's pause for 1 sec. So let's comment on the lake home market up north. Unfortunately, I really just don't have any numbers on that. I can't really make many comments on that. I could pull up the states, the Minnesota associations, their report, and I know they've got some data with what's happening in the Arrowhead region and up by Bemidji and Brainerd and Duluth and those areas. I'd probably want to save that to the end just because I want to get through my content, but it's a really good question. And now there's another question. How many listings would be a 4 to 6 months of supply? Great question. So the number here is pretty easy. If we're selling about 5,000 homes per month, then 4 months of supply, right? If we had 20,000 units divided by 5,000 sales would mean we had 4 months of supply, meaning 4 months times 5,000 sales would get us to that 20,000 in inventory. 6 months, if we're doing 5,000, sales a month, and we want 6 months of supply, we want 5 months of supply, that's more like 25,000. 25,000 in inventory divided by 5,000 in sales equals 5 months of supply. So that's a really good question. And that means we'd need 5 times the supply that we have now, from 5,000 to 25,000. So we're not talking about a 10, 20, 30, 50, even 100% increase. I mean, we're talking a 500-600% increase. All right, let's look at our disappearing act chart. What's happening with active listings priced under 250K? St. Paul, not so bad. Actually, 54% of their listings are still under $250,000. Minneapolis not doing as well at 30% under $250,000. And then metro-wide, because you have all the suburbs in this Twin Cities region that aren't obviously in the core cities, you've got your Lakevilles, your Blaines, your Woodburys, your Wayzettas, your Edinas, and a lot of those will pull up the price, which means it shoves down this percentage of listings under 250K. So that makes sense. So kind of a different story here. I shouldn't say different story, kind of a different approach here, a different angle. I can't recall if we had these last time. I think we had a couple of them. So I think you guys will like these. So what's the message here? Historically low rates and rising incomes have partly offset the price gains that we've seen. So we're looking at the percentage of pre-tax median income spent on the mortgage of a median priced home. Back here, 06, I shouldn't say buyers, homeowners had to spend about 25% of pre-tax income on housing, right? 25%. Heading into the Great Recession, that figure went down to 13%. Now it went back up to 20, and now it's about 18.5. Let's do the math. Income, typical median family income is about $103,000. Can be two wage earners each making 50, 51. Can be two wage earners, one making 80, one making 23. Can be one wage earner making 103. Could be four wage earners each making 25. Or, obviously you have households with no wage earners who are earning capital gains in the millions a year, right? With no workers. So a lot of different ways to get here, but this is kind of the median. 18.6% per housing equals $19,000 a year on housing, which amounts to $1,600 per month. Pretty interesting here. So how about kind of what we just did, the monthly principal, interest, taxes, and insurance payment, your all-in payment on that median priced home? Well, there's our 1606, my friends, right? So still that same 103,000 in income, 18.5% roughly to housing, equals about $19,000 on housing, divided by 12 equals about $1,600 a month, right? That's on the median priced home. That's assuming 10% down. Not everybody can get there. Some get to 20, some get to 2 or 3. It's also assuming, we make some other assumptions on insurance and tax rate. These are not random. This is based in data. So we feel pretty good about them. But obviously, some people will be higher or lower. Just know that. What's so interesting about this, I know, kind of geeking out on this one. What's so fascinating about this one is we hear a lot of people lament endlessly about prices, right? But so few people pay cash for a home. This is, as our president Todd Walker loves to say, this is a monthly payment business, right? It's a monthly payment business. And when you look at the monthly payment of $1,600 a month, it's actually lower than the $1,620 per month that we used to spend on a mortgage in 2006. How could that be? Interest rates, right? It's interest rates. It's also rising incomes, but interest rates have more of an impact, more of an effect. Excuse me. PTI, price to income ratios. How much of my family's income, how much of my household income will I have to spend to get a house, right? And here it's about 3. In case you need help doing the math, right? No problem. We're here. 103,000 income, right? Same figure. 103,000 in income, $305,000 home. That's right. So 3 times 103 would be what? 309. Because we're not quite 309, we're a little bit less than 3. So there you have it, right? About 3 times incomes. Now that is about where we were in 05. And we plunged kind of below 2 as a ratio, right? Where families only had to spend about 2 times their incomes. But now we are back to 3. And some of you may be concerned looking at that. I suppose there's some room for concern and discussion. But I think we have to compare ourselves to others. And our friends in San Francisco are spending 10, 11 times incomes. Even our friends in San Diego and Denver and Austin and Boston and Seattle and Portland, right? And Charlotte, some of our friends there still have to spend 4, 5, 6, or 7 times income. So I think we like to moan and groan a little bit about affordability relative to our own past. But when you really compare us to our peer cities, right, to our sister cities that are, similar size, I don't think New York or Chicago or LA would be sister cities. I also don't think Lincoln, Nebraska is a sister city. So, let's be reasonable here, but everything is relative. And what this does is it brings in local incomes and local home prices, and it allows us to compare to, the same data for other regions. And that's important. All right, I got a little geeky here, forgive me. This is our monthly PTI payment on the median priced home. So this is your payment in blue, right? We already saw that 1606 compared to 1622. And then this is just quite simply that median price, right? There's our 305 versus 230 at the peak of the bubble. So look at the gap here. Look at payments. There was a huge gap, right? Payments were up here, prices were here. Now, right, even though prices in red are well above the 230, right, payments aren't. And that's, again, because of interest rates. Even as prices have continued to march higher, I even sometimes say stomp higher, right? They've been stomping ever higher. Actually, payments have been really flat over the last several years. And again, that's because of interest rates. All right, I know I referenced our friends in other cities, in some of our peer cities or sister cities, and that is exactly what we see here. So San Francisco's median home price hits 1.6 million. Well, let's hop down here. San Francisco, right? This is the HUD data for median family income, 143. Here's the Minneapolis-St. Paul Metro, median family income, 103. So sure, they're making, what is that, about 40% more than us in the Bay, right? 40% more than us. That means they can afford about 40% more house. Let's be generous. Let's say 50% more house. What's our home price? 300,000. What's 50% more of 300,000? 150. That would get us to 450, right? So if they had our same levels of affordability given their incomes, their prices should be 450, right? And that would be equivalent to our price of 300. But no. They're over $1.5 million. And that's why their price to income ratio is 11 to 1, right? Simple. 1.6 million, 243,000. Price to income ratio, right? So I mentioned Boston at 4, Atlanta 4.5, Denver almost 5, Seattle 6.5, so on and so forth. I didn't find a ton below us. I did find Pittsburgh. I would bet Detroit and perhaps Cleveland. I didn't pull Chicago, and we can't always find data for all of these guys. What can we say? Not everybody is as committed to reporting and to transparency as we are. Let's skip that one, kind of a wonky one there. So, this is, again, long-term. This is our great mean reversion. This one shows the actual price movement in blue. You can really see our bubble here in 05, 06, right? Followed by our crash. So this was the party. This was our hangover. And then I've also plotted these two other trends. This is a 5.3% annual growth rate, as well as a 5.5% annual growth rate. I wanted to put an upper and lower bound on it, and it's not random, right? The average is 5.4%. In other words, the average growth of this blue trend line, even including the declines, the average growth is 5.4%, going back to 1960. So what I did is I said, well, let's put a lower bound at 5.3 and an upper bound at 5.5. And what that means is this channel here that you guys see inside these bounds, this channel sort of represents historically typical appreciation, right? You guys will notice we were kind of in that channel. And then as we saw hyperinflation and 18% interest rates in 81 and 82, we kind of got out of that channel. Then we kind of went back toward it, and then our bubble brought us way above it. And then our correction took us below it. And what do we notice now? We're actually not above that channel, right? In fact, we're below it. This doesn't really confirm to me that we're in a bubble. In fact, it speaks to me, what it says is we've actually got some room to go before we're kind of above this channel. So again, just another tool, just another lens. This is not conclusive evidence, but it's another way to kind of look at things and maybe calm some of those fears or concerns. Okay, I see we are coming up on time here, so let's just do one or two more. So this is market activity, again, going all the way back to 67. I just love that we're able to have this pretty old data. So look at new listings. I won't go all the way back here. You guys can see the trend, but look at new listing activity as we headed into 05, 06, right? New listings here in blue, kind of saw this surge in supply. Where were the buyers in red? It looked like maybe they were there, right? We had some exotic loan products where, no doc loans, and we had some other innovative exotic loan products that got some of these folks into homes. But really the demand fell and the supply was still really high. That's what forced prices so low. Look at what's happening now. Demand is pretty tight with supply, right? Pretty tight with supply. So we don't see that same evidence that we saw of a supply-driven bubble that we did several years ago. Okay, let's see what we want to do. Guys, let's just do a minute or two. Let's just do a minute or two on InfoSparks. And if you have to go, we absolutely respect that. But just for those of you who want to see this, I just want to spend just a minute. So if you will indulge me, InfoSparks, external links. InfoSparks, right? Once you're in Matrix, tools, InfoSparks. When you're there, you'll see this sort of default landing page or splash page. So usually we'll be on sales price, where you can see, there it is, folks. There's our 11.5% increase to 301,000, right? And you guys can see the trend over time. You can also see the seasonality over time. Jan heats up into June and July, cools down into Jan and Feb, heats up into June, cools down into Jan and Feb, right? You can see this sort of cyclicality or seasonality to our market. Where so much of the magic comes from is in our ability to break things out into different segments. So here, I'm going to say, show me the sales price, but show me the sales price broken out by property type. So single family, condo, and townhome. Let's make this a little bit bigger. Here we can see single family at 326, condos at 172, and then townhomes in the middle at 240. We can also see the change here. Single family homes up 11%, townhomes up 9%. Condo prices down 6%. Interesting. Let's see if we can spot a trend there. So I'm going to go from monthly to rolling 12 month. And you know what? Let me shut down single family, and I'm even going to shut down townhome. Interesting. Now, wait a second. Are you telling me that the condo market actually started to soften and flatline a little bit back in 2019? Wait a second. I thought COVID was solely responsible for some of the changes we've been seeing in our condo market. It's interesting when the data doesn't confirm the narrative, isn't it? It's possible COVID, well, I would even say it's likely COVID had, a negative impact here. But what's not accurate is to say COVID is it was only at the onset of COVID that we saw condo prices soften. That is not an accurate statement. That COVID is the only thing that started condo prices softening. No, right? We kind of saw that happening into really the end of 2019. And you guys can kind of see that. So pretty interesting insight there. Another way to look at that, guys, so sales price, let's take a look at month supply. Wow, already I can see things. Look at condos in red. Holy son of a rum puncher. 43% increase in condo month supply. We can really see it, can't we? Single family absorption rates are headed down dramatically, 30%. Townhome absorption rates also down, 12.5%. But look at condo absorption rates. This is pretty remarkable, and it's a really good way to visualize some of these changes. So because we saw absorption rates increase in this segment, I would bet you that we would see the ratio of sold to list price also deteriorate. Let's see if we're right. I think we're right. Yeah, look at that. We're right, guys. So look at this. Look at condos in red. Look at that ratio of sold to list price. This tells us condo sellers are only getting about 98.5% of their original price. Single family sellers yielding 100%. Townhome sellers also realizing 100% of their list price. Let us shut down these other two segments. Let's just take a peek at condos. Here again, folks, right? Condo sellers started getting weaker offers. And it started before COVID, right? So perhaps this condo segment had already started to change, back here. There's even some evidence at the beginning of 2019 that things had sort of flattened, and you can see the trend change, right? This is an increase. This is a flat trend. This is a rising trend. Then we got into a flattening trend, and now we're in a little bit of a downtrend. So you can really spot these changes, and I think that's really important. All right, let's just stick on this for one more second. Let's do new construction. Okay, so I know this is an important segment because it's a growing segment, because we don't have any homes for sale and builders need to build more of them. I don't believe they can single-handedly build our way out of this crisis, but gosh darn it, they can try. So new home prices, right? 410,000, existing home prices, just about 300K. You guys will notice there wasn't as much of a gap when so much of the new building product was condos, smaller condos. Now, so much of that has transitioned into new subdivisions, new developments, new single family developments. Let's see, let's do one more. I know we're a couple minutes over time here. Let's do, what should we do? Let's do square footage real quick. Let's do a breakout. Well, I'm not so interested in price, not that it's not interesting. Wow, lo and behold, 2,500 square foot homes or bigger tend to cost more than smaller homes. All right, well, I could have told you that, and I did. Let's look at sales activity. Wow, look at purple. Look at these homes that are 2,500 square feet or bigger. Wow, has something happened? So notice that segment used to be the smallest segment, right? The fewest amount of sales in that segment compared to all others. Now, wow, it's second highest, right? And that second highest has really been a recent change. So look at that purple trend line compared to blue and red. So, you know, red has seen growth too, say 1,800, 1,900 square foot homes. But wow, have we seen growth in this, in some of these bigger properties? That should correlate or correspond with bedroom count. And sure enough, folks, look at 4-bedroom or more homes here in purple versus 3-bed homes in green. And then you've got some of your smaller product, 2-bed homes and 1-bed homes, largely condos, there in blue. So I guess we can shut down condos, and I'll even shut down 2-bed homes. And yeah, you can really see the changes here. So there's been a lot of interest in these segments. Just as a refresher, guys, I want to share these. I'm going to click share. I'm going to say live. I'm going to say share. I'm going to take a peek in a new window. I can Facebook this. I can tweet this. I can email this. I can do all sorts of things. I can also just take this URL and copy it and paste it and send it to whomever I want, right? Let me just paste it and kind of show you guys. It brings us to that same page. And because we chose live, don't forget, we can customize it, right? We can choose kind of what happens. And even though the most recent data point is January, on March 1, this will update with February numbers auto-magically, right? A little bit automatic, but mostly magic. So just a few kind of tips and pointers there. And if you guys ever get lost or confused, please do check out our user manual and the FAQ section. It's really a helpful little tool. So we do encourage you guys to use that. And you guys have been so generous allowing me to go 10 minutes over, and that 36 of you have stuck around with me. I really do appreciate it. I will say, let me get to my last slide because it's a good one. I'm going to stop in the name of love, open it up for any other questions or comments that you guys might have. All right, I see Marie here. So since agents change their status in various ways, TNAS, how is it that you calculate? Yeah, so days, well, here, actually, this is a terrific opportunity to, let's use our tool. Metrics. Median or average number of days between when a property is listed and when an offer is accepted in a given month. So again, as long as I think, oh shoot, it's 12 months. I believe it's a year. If you were listed for 30 days and then you're back on for another 30 days, right? It's truly 60 cumulative. So that's days on market. A lot of people think it's the time elapsed between first listed and closed, and it's actually first listed and under contract. Yeah, it's under contract. Let's see. I think we had a couple more. Also wondering, Tom, any insights into what's happening? Yeah, so I know we kind of looked into some of that. If the question is sort of specific to certain geographies, I would say, you know, maybe do Minneapolis, and then you can do MPLS Central, which is the entire downtown community, and then you can do Loring and say North Loop. Right, so now I've got the city, I've got downtown, and I've got my 2 downtown neighborhoods. So I suppose this is pretty interesting, might as well. Sales price, okay, so oops, I'm sorry guys, I have to filter. Even though, all the product in these two areas, well, even in these three areas is going to be condos, not all the product in the city is condos. So I have to filter down. Interesting trend. I guess I see condo prices softening a little bit in all of these areas. How about month supply? Let's see who's had the most dramatic. It looks like Loring. It looks like Loring's had the biggest increase in absorption rates, 140% to 7 months of supply. It's a pretty big change. That's a pretty big change. So I'll take Loring off. Yeah, I mean, when you think about the city and some of these neighborhoods, I don't know that that's as dramatic, but Loring, that's a pretty dramatic change. Yeah, that's a pretty dramatic change. You guys will also note that 4 to 6, or well, I guess 4 to 7 months of supply. These are all technically balanced markets, but look, it wasn't that long ago, right? Well, we don't have to go all the way back here to see sellers markets, but it wasn't that long ago where most of these guys were in sellers market territory. So just keep that in mind. Someone else is asking about slides. Absolutely, we will send out the slide deck. We are more than happy to. You bet. And with that, should we wrap her up? I think we will. I want to say thank you to all of you again, those of you who have stuck with us especially. I really appreciate it. We also want to say there are so many reports and data and tools out there for you guys to use. Sometimes it can be overwhelming, and that's why we really encourage you guys to take a look at the FastStats interface. Really become best friends with InfoSparks. It's just such a powerful tool. And then, of course, we were talking about the FastStats. Just know that in these local market updates, I click Hennepin County, I click Plymouth, and boom, couple clicks, I've got a really nice tool for my sellers at an open. If I'm working with a buyer who wants to be in an area, what have you. We've got the month and we've got the prior 12 months. So a ton of great data here. And as we say, use the data for good and never for evil. And I know you guys always would. And just keep your questions and comments and feedback coming. And we hope to see you guys next time. Thank you so much.